Thank you, Rob. Good morning, everyone, and welcome once again. It certainly has been quite an interesting first half of the lineup so far. So for the next half of our program this morning, we've got three very interesting speakers as well. So we've got Tony Cousins from Pyrford Asset Management, we've got Andrew Headley from Veritas, and we'll end off with a Q&A at the end with Jeremy Lang from Ardeva Asset Management. So without further ado, let me introduce our first speaker in my segment of this morning's program. So Tony Cousins is the CEO and CIO at Pyrford Asset Management. He is the manager of the Nedgroup Investments Global Cautious Fund, a low-risk fund with a maximum 40% equity exposure that aims to produce stable long-term real returns in excess of money market while producing lower volatility than equity markets in general. Tony, welcome, and over to you.
Thank you. Thank you very much. Good morning to you and good morning to everybody on the line. I will just share my screen to bring the presentation up. Actually, hopefully you can see that, and I'll put it on full screen view as well. Can everybody, can you see that, the screen share? Right, I'm not hearing anything, so I'm assuming that is okay.
Go ahead, Tony, it's fine.
You're okay, sorry, I've lost all sound. Right, good morning. I'll get straight into the presentation because I know time is short today. The portfolio had a good quarter, delivering 1.9% in total. And as you can see from the slide on screen, we had positive contributions from all asset classes, the largest contribution coming from equities. We have highlights on the next screen. One point I would like to make is that our short duration positioning in bonds did protect the fund from losses in the rising yield environment. You will see sort of mid-single digit declines in the indices there. Obviously, as bond yields rise, bond prices fall, but longer duration bonds fall obviously much more sharply than shorter duration. So the declines in the indices is for the entire yield curve. If you'd been holding even longer duration securities, those losses would have been in double digits. So the very short duration positioning aided the portfolio. As I say, equities were the main contributor. In overseas equities, we marginally lagged the index, but in US equities, we outperformed by in excess of 8%. And this was driven by a switch in leadership to more value-oriented stocks, which I will come on to talk to. Currency hedging was marginally positive. The currency we have hedged for this portfolio is the Australian dollar, based on purchasing power parity. The US dollar rose against that, so that hedge was positive. Elsewhere, currency was also a positive, as the two largest exposed currencies, sterling and Canadian dollar, both increased in value against the US dollar, and these are hedged. Just on the negative side, we obviously could have made you more money if we had had a higher weighting in equities, but I'll come on to discuss why that wasn't the case. In terms of activity before we get on to that, the presentation today is highlighted or entitled Protecting Capital, and this is something very dear to our hearts at Pyrford, and this is just a slide which illustrates the importance of this. This takes two 10-year periods, both starting with 100,000 and having a compound growth rate of 6%. But the one on the left has that compound growth rate broken down with the highest annual returns in the early years and the lowest annual returns in the later years. And the opposite is on the right hand side, and this assumes a £6,000 withdrawal every year. This is what's known as sequencing risk, and what it clearly shows is protecting capital in your early years is very, very important, because if you suffer losses and withdraw money, your subsequent pot will shrink quite markedly, and we see about £45,000 worth of difference between the example where the high returns are in the early years compared to the low or negative returns. So this shows the importance of protecting capital, which is central to the Pyrford approach. How we implemented that during the quarter was a further reduction in equities, which took place in January. You'll recall that when markets fell very sharply last March, we increased the equity weighting within this portfolio. The facts changed, we changed our point of view. Equities were cheaper, so we bought them. By the time that June came along, the valuation attractions had dissipated, so we reversed that position from March. And as equities have continued to rise in January this year, we took the decision to take more risk off the table and reduce the equity weighting in the portfolio to 20%. These are the reasons why. Markets are indeed very expensive. Here we show the MSCI World Index and its price earnings ratio since the end of 2019. Markets went into 2020, to our mind, fairly expensive, selling at about 20 times earnings. They fell to around 15 times earnings, at which we bought more. But since that point, they have continued to get more expensive as both market levels have gone up and earnings have fallen away. The result is today equities are selling at 30 times earnings, which is a very, very rich proposition with significant downside risk. And you'll see from the left-hand chart, this is well in excess of anything seen in the last decade. So this is concerning, and we have acted accordingly. When we look at dividends on this slide, a very similar picture. We entered 2020 with a dividend yield of about 2.3%. That got up to 3% in the market fall, at which we bought more equities, but that has now declined to a very slim 1.7% as equities have risen and dividends have been cut. Dividends had been cut on a global aggregate basis to the tune of double-digit percentages. This has not been even around the world. Europe has suffered much more than Asia or the US. Aggregate dividend cuts in 2020 in continental Europe were 25%. In the UK, they were 35%. But markets have continued to rise, and this is leaving you with a very meager yield on equity portfolios. So that was one of the key reasons for the reduction in equity weightings. Market rises have been driven predominantly or to a very great extent by the US, and US valuations are particularly stretched. The ratio we have up here is Warren Buffett's favorite measure of value, which is S&P 500 market capitalization to US GDP, the size of the stock market relative to the economy, and we can see here justices. This is outside 2 standard deviations away from its 30-year average, and this really is quite a concerning chart from our point of view. Within 2 standard deviations from averages, what a market is for more than 95% of the time. So this is very much an outlying level of valuation. In the US, the rise in the market has been led very much by technology. Here we have the growth index relative to the value index, the dark green line, and that has been up until recently in a very sharp bull market, which has been coincident with the fall in bond yields. This can be explained by the fact that growth stocks are long duration equities. They don't make a lot of money now, but there's a promise of a big pot of gold at the end of the rainbow. If you discount that pot of gold back to today's valuation with a very low discount rate represented by government bonds, that's how you can justify some of those high valuations. The problem now is that bond yields have started to rise, and that trend has gone into reverse, as we can see with the downturn being seen in 2021, the first quarter. We are a value manager. We buy stocks because they represent good quality and good value, and in this environment, value is doing an awful lot better, particularly in the US, which is why we have been able to outperform by so much in the first quarter. I will just finish off, because I think my time is coming to an end here, with just an overview of how the portfolio is positioned in general. Equities representing 20% of the portfolio, the majority of that in non-US equities, reflecting our view that the US is very expensive. And of those non-US equities, the largest position is in Asia, excluding Japan. This is the market which has weathered the COVID crisis the best, which has returned to growth the fastest, and which is seeing sustained recoveries. And we also think that in the long term, these are the markets with the best economic fundamentals. They have the best demographics, they have the strongest productivity growth, the lowest debt penetration, and the highest savings ratios. Let's not forget that 58% of the world's population are Asian. They account currently for about 31% of world GDP, but only about 13% of world stock markets. One theme we have been pursuing for a long time in this portfolio is the inexorable rise of Asia, and this continues. We do expect that imbalance between population, GDP, and market cap to be corrected. It will take many years, but that is a positive tailwind behind Asia. The bonds within the portfolio, both US and non-US, are very low duration, 1.747 years. That is to protect the portfolio in a rising yield environment. And you can also see that the unhedged currency exposure, overseas unhedged currency exposure, is relatively high, 43.6%. We manage this within a risk parameter of 0 to 45. The advantage for a US dollar investor is the US dollar is a very expensive currency on purchasing power parity, which is the valuation tool that we use. As that is corrected, that will be a return driver in unhedged overseas currencies. We can't leave everything unhedged because that would break our risk rules. So we hedge the most expensive currency, which is the Australian dollar, which in the first quarter proved a profitable thing to do. So I think my time is up at that point, so I will pause there, and we'll be happy to take any questions on how we've been managing your money, and how we see the future in our markets.
Thank you, Tony. That was a very nice and punchy presentation. We do always appreciate when our attendees send through their questions, and in fact, we've actually got quite a nice one from the audience today for you. So this one refers to US inflation, and specifically in terms of the stimulus that's coming through in the US. What if the beneficiaries of that stimulus actually just tend to save more as opposed to spending the money? Just in terms of your view, is that in line with rising inflation or not? And what do you think about that?
Well, I think the inflationary fears have clearly risen. The US has got on with its vaccination campaign and is clearly seeing a recovery, and the Biden administration is using its current political advantage in Congress to drive through very large stimulus programs. We have seen the 1.1 trillion bill already passed. which is largely distributing government money to individuals and giving additional relief packages. This is 9% of GDP. This is huge, and they are following this up with a infrastructure bill, which is currently targeted at over 2 trillion. So that's about 18% of GDP. That is gargantuan. Now, if you stimulate an economy which is already recovering to that extent, then you are going to build inflationary pressures. Those who have accumulated a lot of debt will use the money to pay that down, but others, because they haven't had the opportunity to spend, will use it to spend. And clearly, in infrastructure, that is government money that's not going to go through individual wallets, so that is going to get spent as well. So I think there is concern going forward about rising inflationary pressures. The Fed have said that if rising inflation is seen, they will allow the economy to run hot and not tighten, as they've done in previous cycles, while the recovery gets firmly established. And the risk is that inflation keeps on rising. This is at a time when bond yields remain very low. Bond yields have gone up about 70 basis points in the US, but they are still negative in real terms, or just marginally below zero in real terms, as they are throughout the world. And that presents huge risks for bondholders. In a rising inflationary environment, when you're coming from such low yields, you don't want to own duration in fixed income. So I think that is a very valid concern. The other part of this is money supply. I don't want to get into the technicalities of monetary economics, but we have seen a very rapid rise in broad money growth in the US, around the world, in fact, but particularly in the US, and that tends to presage rises in inflation by about 18 months to 2 years. There will be just technical rises in inflation as some of the falls from this time last year, particularly the oil price, drop out of the calculations. That is to be expected. But if this then gathers pace, I think that is a very difficult period for markets.
Thanks very much, Tony. That was certainly very insightful. We do appreciate your time, and we look forward to your good performance over coming quarters.
Okay. Well, thank you very much for your time today, everybody.